Well, howdy there, folks. Welcome into today's video. A few things to speak about. Right at the top, I want to talk about Red Dead Redemption, like the last trading day of the year, and it seems like just about every stock in the market is red here today. So I want to speak about why that happens. Does this mean anything for 2024? Is this like an omen of like, oh boy, we're about to be in trouble in 2024. It's about to be a massive pullback or crash or something like that. So we'll speak about that at the beginning of this video. Then I want to go ahead and get into two reactions. It's a two-piece here today. First one up here is Tom Lee went on CNBC a few hours ago, spoke in depth about his thoughts on 2024 for the stock market, where he sees things going. So I want to react to that one, give my opinions and perspectives. And then the other video I want to react to is this one. This one's actually from last night. This gentleman was speaking about small cap stocks breaking out of their trading range beginning of 2024 and a few other things in the market. So appreciate y'all joining me as always. Thanks so much for being here. Thank you for being subscribed to the channel. Appreciate each and every one of you. Also, I just made moves in the Patreon portfolio. I bought 3 stocks in that one here today. If you're looking to join that tier, join it today because we're about to go up to $25 a month for this particular tier. So, you know, if you want to get in for the $19, get in, and then you're grandfathered in at that price. Otherwise, we're about to go up to $25 here in the next 48 hours. So there'll be pinned comment down there if you want to join me there, okay? So in terms of, you know, Red Dead Redemption Day, I mean, all these stocks are red. It's red across the board, right? It's like, oh my gosh, like, it seems like everything. Like, I was looking at stocks I hold. Almost every single stock is red today, right? So first thing is, well, why are all these stocks red here today, right? Well, think about it. It's the last trading day of the year, right? The last trading day of the year. What are you more inclined to do on the last trading day of the year? Buy stocks or sell stocks? Well, let's think about it. If I want to buy, right, I could buy today. I could also buy Tuesday. Does it make any difference? The answer is no, right? It really makes no difference. Selling, it makes a massive difference though, right? If I want to book any gains or losses for any stocks, I got to do it today. It's the last moment for me, right? It's like going out Christmas shopping the day before Christmas. By the way, I went out there Christmas Eve. Holy smokes, it's shocking to me how many people wait to literally last minute to go Christmas shopping. I was like, my in-laws wanted to go to the mall on that day, and I was like, oh my gosh, so busy. And just like a lot of people wait last minute to go Christmas shopping, a lot of people wait to take losses or gains till the very last trading day of the year. Okay, now with that being said, does this mean anything for next year, for 2024? Is this like an omen? And the answer to that is absolutely not. This means absolutely nothing. All these stocks could be green today, red today. It means nothing. It means absolutely nothing. Nothing. Like, you know, it has nothing to do with what this means for 2024 or anything like that. It's just, think about it logically. Like, a lot of times in the stock market, you just have to use common sense. Like, common sense comes very key in many various ways, okay? All right, guys, let's go ahead and jump into these two reactions here. All right, Mr. Tom Lee up first.
In the new year, joining us at Post 9, Fundstrat Global Advisors co-founder and head of research, Tom Lee.
Is it me or is it just quiet?
Happy New Year, everybody.
Seems so
everybody
quiet.
was negative this time last year, but you were not. Why?
Yes. Well, it's really two things. One, we thought inflation would fall like a rock, whereas many were bracing for a decade of sticky...
Maybe their babies are sleeping in the background too, so they gotta whisper real quiet. I'm like, it's so quiet.
Inflation. And the second was, if that was true, that we would avoid a hard landing, and soft landing was the most probable outcome. So that's pretty stock friendly, right? Inflation falls like a rock, you avoid a hard landing, and markets were down 20% the year before.
So in 2024, will inflation keep falling like a rock, and will we still have a soft landing?
Yeah, I think your food chart is spot on. I think consumers will realize that the rate of price increases is slowing. We saw it in the UMich surveys. That will give Fed a lot of leeway to cut rates next year to keep real rates constant. Housing and autos is really 70% of inflation. So both are going to normalize, and that means 2% is going to be very visible next year. And I think it's a huge relief for equity markets when that happens.
Tom, Happy New Year. First
New
off, congratulations on your calls this year. You've been directionally correct. That's hard to do, so kudos to you. You're top dog now, 5,200. You have the high estimate for the S&P 500 for 2024. Jonathan Stoltzfus, we just had him on. He also had 5,200. You're top one. I wonder if you can explain what goes into making that up. It's always a little bit of a mystery to us what you macro guys do. You know, an analyst who covers Caterpillar, he studies Caterpillar, you know, earnings estimates and makes a projection, but you have to do this estimate from the top down. So what goes into this? Do you guys get together in a retreat on the weekends and, you know, drink a lot and figure out what's going to, you know, come up with?
You know who Sarah Eisen reminds me of? Sarah Eisen reminds me of, you guys ever seen that movie? I think it's, if I recall, it's Remember the Titans. Is it Remember the Titans, or is it that other football movie? I think it's Remember the Titans, right? I think it's that movie, and the one coach has the little daughter who's like super into football, and she like knows all the plays, and she's like this little blonde girl. That's just Sarah Eisen reminds me of. I don't know why.
How do you come up with this 5,200?
Yeah, it's really sort of three parts. The first part is, you know, what is probable based on sort of market history, like where we are in the business cycle, what did the markets do the year before, you know, where's positioning. That's more of a, gives you a pretty wide highway to think about what markets could do. So next year, double digits is more than a 50% probability, even though we were up 25% this year. But then we look at E, the earnings, and we think, can you grow 10%, which I think is easy base case because there's pent-up demand for CapEx.
I don't know if Tom Lee's going to talk about it here, but it's very important we be very clear about what Tom Lee expects for the first half of the year, because he disclosed something that was pretty shocking to me in a interview very recently. And he says in the first half of the year, in 2024, he expects S&P 500 to potentially fall to like 4,300, which would be about a 500-point pullback from here, roughly. And so I thought that was pretty telling. That I was like, wow, he's actually expecting a big downtrend in the first half of the year. And then obviously a huge ramp back up, because if I recall, he's at 5,200 for year end for 24.
And we know the PMIs are going to turn. And the guidance actually has been pretty decent. And then it's what multiple do you apply? This is where I think people make mistakes. When the 10-year is at between 3 and 4%, 65% of the time the PE is over 18 times. 50% of the time it's over 20. That's since 1900. Well, the S&P equal weight is 15 times forward, or ex-FANG, it's 15 times forward. Well, if that 15 goes to 18 or 15 goes to 20, the stock market's going to be up 30%. So we figure, well, you hold the multiple, earnings grow 10, you get 5,200, but that means there's upside to that number.
A lot of assumptions built in there.
Yeah.
A lot of assumptions here. So you move the slider either way on a lot of these assumptions very easily. Your multiple's a little high, though, isn't it, at this point? I mean, I don't like to do ex-FANG and those kinds of things. We're right now the street's at almost 20 times forward earnings right now. I don't know what your multiple is.
Yeah,
you're right. This is where people mess up.
Yeah.
What's a dollar of future earnings worth? That's the multiple.
Well, remember, investors can buy any stock. So if they buy the S&P, if they buy the index, then they're buying the FANG 40% weight at 30 times. But if someone's buying, like you said, JP Morgan at 11 times, or, you know, they're buying 20 stocks in the S&P and they're paying 13 or 14 or 15 times. Yeah. Actually, the 10-year tells you that could be 20 times.
But we're not. We're buying the S&P. You have a 5,200. That's what I'm trying to, you know, you want to X out. You seem to want to move out things and X things out.
Well, actually, the best way to do that is like, well, should the FANG multiple come down next year, right? So you do a sum of the parts. And why should the FANG's multiple decrease when they're going to grow earnings 25%? I mean,
that's a good point.
In a way, you'd actually argue the market has more upside if FANG holds its multiple because of the earnings growth they're going to have. So I think people trick themselves into think the market.
That's a great point. I mean, you know, you look at companies like Meta, Amazon, some of the biggest weights. I mean, their EPS is going to fly next year, right? And you know, I do hate on Apple a decent amount, but even Apple. Let's talk about Apple for a moment, right? Apple's revenues have been downtrending, and yet look at their earnings per share. It's still been growing very nicely. What happens? What happens if Apple starts to grow their top line again? Do you know what's going to happen to their bottom line? If they can grow their bottom line even with revenues downtrending, what can they do if they actually start growing revenues again, right? And that's the biggest way to them all. We know Mr. Softy's going to put up great numbers again next year, right? Amazon going to have tremendous EPS growth. Amazon's EPS growth could probably be the strongest of any of the big dog companies. I feel pretty confident about that. Meta is going to be extremely strong. We know NVIDIA is going to be there super strong. We know AMD is going to be there super strong, right? When they don't quite get put in that biggest category, but they're like, let's call it a layer beneath that. Google's going to be fine next year. So, you know, I don't know, man. That's a little food for thought in regards to that. I think Tesla's a wild card. Tesla's really a wild card in regards to what happens there. I think Tesla, you could see very nice EPS expansion in the back half of the year, but I think the first half of the year will still be shaky for Tesla.
But it's the same as someone saying, oh, because the S&P is expensive, Japan's expensive. It's not. You know, you're buying equities, but you really want to think about each component you're paying for.
I want to talk about your small cap call, because that's a big one. 50% next year. We've certainly, if that happens, had a preview in the last few weeks about the comeback in small cap. Why do you think there's so much room left to run here?
Well, I think people need to put a long-term lens on small caps. On a price-to-book basis for Russell, which is the highest correlation to forward returns, relative to S&P, it's at the 1999 lows. You've never seen them cheaper. 1999 was...
That's always the case for small caps, is that they're cheap.
It's the first time they've touched these levels in almost 40 years.
Yeah, it's about how cheap are we talking, right? It's not just about, oh, they always trade cheaper than the market. It's about how cheap are we really talking, and that's what Tom Lee's main point is here, right?
So, but in 1999, that was the launch point for 12 years of gains. And if you look at the earners of the small caps, which is like the S&P 600, they're at 11 times forward earnings. So can the multiple expand in small caps if we have weaker dollar, PMIs turn up? Yeah, I'd say easily. Can the earnings go up a lot? Yes. And, you know, small caps this year proved it. You know, we turned bullish on small caps around November, and people thought maybe it's just to base it up 5. It's up 25%. I think small caps could easily add 50 percentage points next year.
But can small caps rally when large caps are not rallying, when tech is not rallying?
There's a lot of precedent for that. Like 99 to 2003, you had a pretty vicious bear market. Those were some of the best absolute return years for small caps.
Small caps, long terms, tend to outperform big caps. Value tends to outperform growth. It just doesn't happen in our recent memory that much. Wouldn't that be something if that happened?
Yeah.
Yes, and you know, many are skeptical small caps could work. Most think it's a tourist trade, like they want to maybe own it for a couple months.
Yep.
So the more less likely outcome is they do well the entire year.
Right. And I know you expect a little turbulence in February, right, March?
Yeah.
Ooh, good question.
Yes, I'd say if history was sort of your guide, January, February, S&P gets to 5,000. I mean, I think new highs is just a matter of days.
Whoa. Okay. Ooh. Okay. So he's expecting January into the beginning of February to be booming.
March, late Feb, March, April is when you get the 5-10% drawdown.
And then up from there.
Yeah, and then up from, but that's the big growth scare, and so everyone will panic, and that's probably the time to be buying again. So.
Well, no doubt we will be speaking to you many more times before
Okay.
that. Thank you very much,
Thank you.
Tom Lee.
So where he's taking this
Happy New
from
Year. As we hit a break,
is,
here's our roadmap for the rest.
let's see here. Where is it at? There's my seasonality chart. So this is my seasonality chart here. Election years, sitting president running. So that's a green line there. And, if the market performs anything like it usually does, we should have a booming January all the way until we get to about Valentine's Day, and then a major pullback from there, all the way into kind of March's time, right? You can't bank on this because sometimes people try to front run it, or, just because it's happened in the past, and it usually happens, this is basically the last 70 years or so. Just because it usually happens doesn't mean it's going to for sure happen. So that's just a little food for thought in regards to that. But, yeah, if it plays out anything like it usually plays out, we should boom in January all the way until we get to about V-Day. And then right around Valentine's Day, we'll peak, and then we'll start downtrending for a bit. So interesting. You remember this chart, and we'll see if it plays out that way, right? But it would be kind of hilarious if it does play out that way. And clearly, Tom Lee thinks it will play out that way, which I think is very intriguing. Okay, next one up here. Maybe it'll be a little louder. Small cap should break out of their trading range at the beginning of 2024, says this gentleman.
Chief Investment Officer. He has $2 billion in assets under management. James, it's great to have you on. I'm looking at your notes here. You're bullish. You're bullish going into 2024. Why?
Happy holidays, Morgan. And we are very bullish about going into the year and even over the next maybe 6 to 10 years as we envision a new super cycle sort of led by AI tech, if you will. And I think that here specifically, investors need to remember...
That's interesting, 6-10 years. By the way, that gets into a very important point. Very, very important point, right? Because there's the belief is right now that we are very late stage cycle and it's a countdown to the big crash, the big stock market crash, the big real estate crash. That's a belief I think most economists have, most people on Wall Street have, and this is not a new view. They've really had this view for the last few years here, right? They really view us at the end of the cycle and we're about to break this and it's just a matter of time. Is it 6 months, 12 months, 24 months? Boom, it happens, right? But there's going a little thought process to another side that almost no one's considering. Maybe this gentleman, maybe a Tom Lee, but almost no one's considering this other thought process out here. And that is we're early stage on the next cycle. And so which means is if you look at 2020, epic crash in the market, super high unemployment, right? 2022, big crash in the market, not super high unemployment, super high inflation. So you had two very dramatic things happen all in a very short amount of time. And so it is a potential that we could be early stage cycle and we actually have a beautiful next half decade, something like that, right? I'm not convinced either way. I'm not convinced we're at the end of the cycle or the beginning of the cycle. I kind of see it both ways. I'm like, yeah, I could kind of see how people think we're at the end of the cycle and we're waiting for the big one to happen. And then I look at it and I'm like, there's a very few people who think we're at the beginning of the cycle. And I'm like, I can see how they think that because of, what has happened and transpired over the past few years, right? And so I can see it both ways. And honestly, none of us will really know until the years tick on, and then we'll be like, oh yeah, that was early stage cycle, or well, that was a late stage cycle. The crash did happen, right? So now it's just kind of a game of wait and see over this next few years.
What does a new bull market look like? And if you really go back and look at history, you'll see oftentimes new bull markets sort of start like this one has, a little narrow, then it starts to broaden out as we saw last quarter. And when it gets to these extremes, these heights, oftentimes investors get scared and they think, oh, it's gone up too much. Maybe I'll stop investing. And that would be a mistake in our view. We think that investors still have a lot of capital outside of the market from the bear that occurred. And we think January effect, if you remember that one, Morgan, is going to come into play as we get to the beginning of the year. And that's usually where the market broadens out even more, goes up even more than people expect.
Yeah, the shocking thing is, you could make an argument it's always time to buy the stock market. Always. Literally, it's always time to buy the stock market. For instance, let me pull up the NASDAQ for you guys. I want to pull up the NASDAQ here. And we can back it all the way out to the tech bubble days, right? So imagine you're buying in the tech bubble, 98, 99, you're buying the NASDAQ at 2,000. You're buying the NASDAQ at 3,000, 4,000 plus, right? And then it's going down and you're buying it back at 4,000 again, 3,000, 2,000. Oh my gosh, you're buying it here at 1,000 and people are looking at you like, man, you are an idiot. Like you were buying at 2,000, 3,000, 4,000, blah, blah, blah price. Now you're buying again at 2,000, 1,000, Would you have liked to buy the NASDAQ at 1,000, 2,000, 3,000, 4,000? Yes, you would have loved to. Over time, in hindsight, it was the ultimate perfect decision to be making, right? You would have looked like an idiot during that time. But I mean, if you're just buying throughout the years as your life goes along, oh my gosh, you end up looking like a genius long term, right? It's just in the short term, you could look potentially very bad. And so, this is the whole timing the market game that people like to try to play and think, and then they feel bad about themselves. And some people sell out at really bad prices and they're like, it's never coming back. And, oh gosh, at the end of the day, every dip in the NASDAQ over the past 30, 40 years has been a buying opportunity. Every dip, every one, should have been buying last year. Should have been buying the prior year. I mean, it's always, in the dips we have nowadays and the crashes, and, in the long term, it ends up kind of looking like small potatoes, right? I mean, it's no different than I just showed you that chart. I mean, look at even the tech bubble. I mean, nowadays it kind of looks like, wow, that was just a little something, right? Fascinating. The crash we had last year in the NASDAQ dropped more than the entire NASDAQ was back in the tech bubble. Like, let that sink in for a moment. We lost 5,000 points or so on the NASDAQ last year, right? Peak to trough. Actually, over 5,000 points. And in the tech bubble, the NASDAQ, was less than 5,000. I think we might have peaked at 5,000 at the very, very peak of the tech bubble. But for the most of the tech bubble, it was kind of 3,000, 4,000 range. We lost more than the entire NASDAQ last year, right? And there's going to be some day where the NASDAQ loses 10,000 points in a year. 10,000, folks. So that will be coming. And then that will be just a small drop. 20 years later, 30 years later after that. Crazy to think, right?
It brings the small cap stocks, obviously, which have been challenged. So we think that trading range that small stocks and the rest of the market have been in breaks out in January as money flows back into the market.
Of course, the small caps, the Russell 2000, ending the day down about 1/3%. But in general, as of late, have had a pretty strong rally. I do want to get back to your comments, James, about this AI-led bull market. But first, let's expand the conversation. Let's bring in Paul Hickey, co-founder of Bespoke. Paul, the fact that we're on record watch here for the broader market, for the S&P 500, assuming we hit that at some point here in the coming days, how meaningful is it to rack up a new all-time high for the S&P versus what equities do from that point on?
Yeah, so hey, Morgan, when you look at these periods when we go a long time without, it's been nearly 2 years without a new high, forward returns for the market have been positive 12 out of 13 times in the post-World War II period. So, we talk about being at near record highs right now and how we've had the best November, December in a very long time, and it's been a very strong year for stocks. But at the same time, the market has gone nowhere in the last 2 years. The S&P's flat, and the Russell 2000, as James was just talking about, has been weaker, and it's been stuck in a range. With 2000 was the ceiling. We've just started to break out of that range recently. And the key here, I think, is for the broadening out of the market theory is the loosening of financial conditions, lower interest rates. Interest rates are still at restrictive levels, but it's the direction that's most important, and they're going down. So I think in that respect, when you look at these prior periods where you've seen this loosening of conditions and such, the market overall has done well, but just as importantly, small caps have done very well as well. And you may look at and say, oh, well, small caps have had this monster run in the last 2 months. But when we've looked back at prior periods, when you see a strong run in the Russell 2000 over a 2-month period, it's generally been a precursor to further above average gains.
Okay. James, I want to pick up on something that Paul just touched on, and that is the broadening of this rally and what that means amid loosening financial conditions. We've got a Delivering Alpha survey that was conducted, and one of the questions that was asked here is which will be the top performing areas in the U.S. in 2024. And among all the different sectors that were put forth to investors who took the survey, 35%, so the majority in this survey said financial stocks will be the top performing sector. Do you see it the same way?
I like that survey, and I appreciate you bringing it up. I think that where the best relative earnings growth is going to be in 2024 is where you want to be as an investor. And I would suggest that financials, absolutely. The valuations are almost historically cheap, as our small caps. But the financials, absolutely, I would be in there. I also think, you cannot ignore the fact that it is an AI tech-led new business cycle, new bull market. You've got to be in those tech companies. Even if the valuations seem expensive, the growth is there to justify it. So, yeah, we would go with big tech, AI, financials. I have to agree with consensus, which I usually don't. but yeah, and I would suggest definitely the small stocks as well and the industrials.
So in regards to financials, that goes into a little bit of, I have a view that we could potentially right now be in kind of like, let's call it the 2002, 2003, 2004 time frame right now. What do I mean by that? Well, you're the tech bubble pop, obviously. 2000, 2001, most of the damage is where it happened. Then you kind of had a bottoming out cycle in 02, 03. Market started to come back a bit into 04. And if you look, like, what really performed tremendous kind of 03 to 06 or so. or even '07, it was financials and it was housing, right? We had a huge blow off the top real estate boom. We had obviously a tremendous time for financial related stocks if you look back at that period, right? And is it possible we're in one of those time frames, we're going into one of those time frames where, maybe people think real estate's high right now, get ready to pay prices in a couple of years from now. It's a potential, right? And maybe we have some sort of epic blow off the top that people are just shocked by. And in that market, financials would do tremendously well. And then they would have a tremendous fall coming, a few years from now. So it is a potential, and it's something I think that should be at least considered out there out of many possibilities. All right. Appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for being subscribed to the channel. Once again, I made moves in the Patreon portfolio today, bought 3 stocks. And if you're looking to join in there today with the pinned comment, because we're about to go up to $25 a month for that tier. But if you join now, you get grandfathered in at the $19 a month price. So just a little food for thought in regards to that. Alrighty, guys, much love as always. Oh, by the way, we're not changing the price as far as the VIP bundle. That one's staying the same. It's only the buy the dip and never trip with the Discord chat for that one, okay? Much love and have a great day.